Look, I'm going to be direct with you. What we're seeing right now in the global financial system isn't just another market cycle. It's not just inflation. It's not just central bank policy gone wrong. We are watching the slow-motion collapse of the fiat currency experiment, and most people have no idea what's coming. Let me paint you a picture of what's happening right now, behind closed doors, in the halls of central banks and treasury departments around the world. Because once you see it, you can't unsee it. And more importantly, once you understand it, you'll know exactly why hard assets aren't just a good idea right now. They're essential for financial survival. The dollar has been the world's reserve currency since the Bretton Woods Agreement. For decades, it's been the foundation of global trade, the benchmark for commodities, the safe haven in times of crisis. But here's what they're not telling you on the evening news. That foundation is cracking, and the cracks are getting wider every single day. Central banks around the world are dumping dollars at a pace we haven't seen in modern history. China, Russia, India, Saudi Arabia, these aren't small players. These are massive economies that are actively reducing their dollar holdings and converting them into hard assets. Gold, specifically. The World Gold Council reports that central bank gold purchases have reached levels not seen since the early 70s. Think about that. Central banks, the institutions that print money, are buying gold like their lives depend on it. Why? Because they know something. They understand that when you can print unlimited amounts of currency, that currency eventually becomes worthless. It's not a matter of if, it's a matter of when. Let me take you back to a moment in history that most people have forgotten. August 15th, 1971. President Nixon closes the gold window. He severs the last link between the dollar and gold. At that moment, the dollar became a pure fiat currency, backed by nothing but faith in the U.S. government. And you know what happened next? The purchasing power of the dollar has declined by over 97% since that day. Think about what that means. If your grandfather had $10,000 in cash in 1971 and just held onto it, that money would buy him about $300 worth of goods today. That's not inflation. That's currency destruction. And it's accelerating. The Federal Reserve's balance sheet has exploded from under $1 trillion before the 2008 financial crisis to over $8 trillion today. They've printed more money in the last 15 years than in the entire previous history of the United States combined, and every single dollar they print dilutes the value of every dollar you're holding. But here's where it gets really interesting. The bond market is starting to rebel. Treasury yields are spiking despite the Fed's attempts to control them. Foreign buyers are backing away. Japan, which has been one of the largest holders of U.S. Treasury bonds, has been quietly selling. China has reduced its holdings significantly. These are the countries that have been financing America's deficit spending for decades, and they're walking away. What happens when the biggest buyers of U.S. debt stop buying? The government has two choices: either cut spending dramatically, which is political suicide, or print more money to buy their own debt. And we all know which option they're going to choose. They're going to print. And when they print, your dollars become worth less. Not worthless, yet, but worth less. Now let's talk about what smart money is doing, not what they're saying on television, what they're actually doing with their capital. Billionaires and family offices are moving into hard assets at an unprecedented rate. Real estate, commodities, precious metals, art, collectibles, anything that can't be printed into existence. Ray Dalio has been vocal about this. He's called cash trash and has been advocating for hard assets for years. Paul Tudor Jones has said he's long gold and Bitcoin because he sees the debasement trade playing out. Stanley Druckenmiller has warned about the fiscal situation and positioned accordingly. These aren't conspiracy theorists. These are some of the most successful investors in history, and they're all saying the same thing: get out of paper assets and into hard assets. Gold has been money for 5,000 years. It's survived the fall of empires, the collapse of currencies, wars, depressions, and every financial crisis in human history. And there's a reason for that. You can't print gold. You can't create it out of thin air. It takes real resources, real labor, real energy to extract it from the ground. That scarcity is what gives it value. Silver is even more interesting. It's not just a monetary metal. It's an industrial metal. Every solar panel requires silver. Every electric vehicle requires silver. The green energy transition that governments around the world are pushing, it's massively silver intensive. And here's the kicker. We're mining less silver now than we were a decade ago, while demand is exploding. The supply-demand fundamentals for silver are potentially more explosive than gold. But let's zoom out for a second, because this isn't just about gold and silver. This is about understanding the nature of money itself. Money is supposed to be three things: a medium of exchange, a unit of account, and a store of value. The dollar is still functioning as a medium of exchange and a unit of account, but as a store of value, it's failing catastrophically. When you put your money in a savings account earning 0.5% interest while real inflation is running at 7, 8, maybe 10%, you're losing purchasing power every single day. Your money is being confiscated through inflation. It's a hidden tax that most people don't even realize they're paying. The government loves inflation. You know why? Because they're the biggest debtor in the world. When they inflate the currency, they're paying back their debts with cheaper dollars. It's a wealth transfer from savers to debtors, from you to them, and they're doing it deliberately. Look at what's happening in the COMEX gold market right now. The paper gold market, futures contracts and derivatives, is massive compared to the physical gold market. There are estimates that suggest there are 100 ounces of paper gold claims for every 1 ounce of physical gold in the vaults. Think about what happens when people start demanding physical delivery, when they stop trusting the paper promises and want the real thing. That's when the system breaks. We're already seeing signs of stress. Premiums on physical gold and silver coins have been elevated for months. Delivery delays are common. Refineries are running at capacity. The spread between paper prices and physical prices is widening. These are all symptoms of a market that's under pressure. And it's not just precious metals. Look at what's happening in the copper market. Copper is essential for electrification, for construction, for manufacturing. Inventories are at multi-year lows. Prices are rising. The same story is playing out across the commodity complex. Nickel, lithium, cobalt, all the materials needed for the energy transition are in tight supply. Here's what most people don't understand. We're not just facing a currency crisis. We're facing a resource crisis at the same time. The world has been living beyond its means for decades, consuming more than it produces, borrowing from the future to fund consumption today. And the bill is coming due. The BRICS nations, Brazil, Russia, India, China, South Africa, are working on creating an alternative to the dollar-based financial system. They're talking about a commodity-backed currency. They're building payment systems that bypass SWIFT. They're trading oil in yuan instead of dollars. This is a direct challenge to dollar hegemony, and it's happening right now. Saudi Arabia, the cornerstone of the petrodollar system, is now accepting yuan for oil sales to China. That would have been unthinkable 5 years ago. The petrodollar agreement that has underpinned the dollar's reserve status for 50 years is unraveling. And when the petrodollar dies, the dollar's days as the world's reserve currency are numbered. What does that mean for you? It means that the dollars you're holding are going to lose value faster than most people expect. It means that the retirement accounts denominated in dollars are at risk. It means that the purchasing power you've worked your entire life to accumulate could evaporate in a matter of years, or even months, if this accelerates. Now, I want to pause here for a second because this is important. If you're sitting on $100,000 or more in retirement accounts, you need to understand that there are ways to protect that wealth. Gold IRAs allow you to hold physical precious metals inside your retirement account without triggering tax penalties. I've put together a comprehensive guide on how this works. It's in the description below. It covers the mechanics, the custodians, the storage, everything you need to know. If you're serious about protecting your retirement, it's worth taking a look at. All right, back to the bigger picture. Because understanding the problem is only half the battle. You need to understand the solution. Hard assets are assets that have intrinsic value. They're tangible. They can't be printed or created out of thin air. Real estate is a hard asset. Farmland is a hard asset. Commodities are hard assets. Precious metals are hard assets. These are the things that maintain their value, or even increase in value, when currencies are being debased. Think about it this way. If you owned an apartment building in Weimar, Germany during the hyperinflation of the 1920s, you still owned that building when the currency collapsed. The rents you collected might have been worthless, but the building itself retained its value. People who held cash were wiped out. People who held hard assets survived. We're not in Weimar, Germany. The dollar isn't going to hyperinflate overnight, but the slow, steady debasement we're experiencing is just as destructive over time. It's death by 1,000 cuts instead of one swift blow. And the end result is the same. Your purchasing power disappears. The smart play right now is to convert paper assets into hard assets while you still can, while the system is still functioning, while you can still exchange your dollars for real things, because there's going to come a point where that exchange becomes much more difficult or much more expensive. Gold is trading at elevated levels, but when you adjust for real inflation, it's nowhere near its all-time highs. In 1980, gold hit $850 an ounce. Adjusted for real inflation, not the government's manipulated CPI numbers, but real inflation. That's equivalent to over $3,000 an ounce today. We're not even close to that level yet. Silver is even more undervalued. The gold-to-silver ratio is still historically wide. Throughout most of history, that ratio has been around 15-1. Right now, it's over 80-1. That means silver is dramatically undervalued relative to gold. When that ratio normalizes, and it will, silver is going to explode higher. But here's the thing, you can't time this perfectly. Nobody can. The people who try to wait for the perfect entry point usually end up missing the move entirely. The time to position yourself in hard assets is before the crisis becomes obvious to everyone, because once it's obvious, the prices will have already moved. Look at what happened in 2008. By the time the average person realized there was a financial crisis, the stock market had already crashed. The people who protected themselves were the ones who saw it coming and positioned themselves ahead of time. The same thing is going to happen with the currency crisis. The people who protect themselves will be the ones who act now, while most people are still asleep. The evidence is everywhere if you know where to look. The M2 money supply has exploded. The velocity of money is collapsing. The yield curve has been inverted. Credit spreads are widening. These are all warning signs that the financial system is under stress. And when the system is under stress, hard assets are where you want to be. Think about the psychology of this for a moment. Most people have a normalcy bias. They assume that the future will look like the past. They assume that the dollar will always be the dollar, that their savings will always have value, that the system will always function the way it has. But history shows us that this assumption is wrong. Currencies fail. Empires fall. Systems break. And when they do, the people who are prepared survive and thrive, while everyone else suffers. The Roman denarius was debased over centuries until it was worthless. The British pound was the world's reserve currency until it wasn't. The Weimar mark, the Zimbabwean dollar, the Venezuelan bolivar, all of these currencies collapsed because the governments that issued them printed too much. And the US dollar is on the same path. The only question is how long it takes. Now, I'm not saying you should panic. I'm not saying you should sell everything and buy gold bars and bury them in your backyard. What I'm saying is that you need to have a balanced approach. You need to have some of your wealth in hard assets as insurance against currency debasement. Think of it like fire insurance for your house. You don't buy fire insurance because you think your house is going to burn down tomorrow. You buy it because if it does burn down, you're protected. Hard assets are financial insurance. They protect you against the risk of currency collapse, inflation, financial crisis, and systemic instability. And right now, that insurance is relatively cheap, but it won't stay cheap forever. The institutional money is already moving. Hedge funds are increasing their commodity exposure. Pension funds are adding gold to their portfolios. Sovereign wealth funds are buying real assets. The smart money is positioning itself for what's coming. And if you're not doing the same, you're going to be left behind. Here's another angle most people miss. The energy transition is going to be massively inflationary. Governments around the world are committed to net zero emissions. That means rebuilding the entire energy infrastructure of the global economy. That requires massive amounts of copper, silver, lithium, nickel, cobalt, and rare earth elements. The demand for these materials is going to explode over the next decade, and supply can't keep up. Mining projects take years to develop. Environmental regulations make it harder to open new mines. The easy-to-access deposits have already been mined. We're going to face a supply crunch in critical materials at the exact same time that demand is surging. That's a recipe for much higher prices. And when commodity prices rise, that feeds into inflation, which forces central banks to print more money to keep the economy afloat, which causes more inflation. It's a vicious cycle that feeds on itself. And the only way to protect yourself is to own the commodities themselves, or the companies that produce them. Real estate is another hard asset that deserves attention. Not just any real estate. Productive real estate. Farmland, rental properties, commercial real estate in good locations. These assets generate income and tend to hold their value during inflationary periods. The key is to avoid over-leveraged properties and focus on assets that have real utility and generate real cash flow. But let's get back to gold and silver for a moment, because these are the ultimate hard assets. They're liquid, they're portable, they're universally recognized, and they've been money for thousands of years. When everything else fails, gold and silver still have value. There's a reason central banks hold gold. There's a reason the U.S. government holds over 8,000 tons of gold at Fort Knox, or at least they claim to. There's a reason China has been accumulating gold for years, and likely has far more than they officially report. Gold is the ultimate reserve asset. It's the asset of last resort. And when the fiat currency system finally breaks, gold will be what's left standing. The silver market is smaller and more volatile, which means it has more upside potential. When silver moves, it moves fast. In 2011, silver went from $18 to nearly $50 in a matter of months. That's the kind of move that can transform a portfolio. And the fundamentals for silver right now are arguably better than they were in 2011. Industrial demand for silver is at all-time highs. Investment demand is increasing. Supply is constrained. The stars are aligning for a major move in silver. And if you're not positioned for it, you're going to miss it. Now let me address the elephant in the room. Some people will say, but gold doesn't pay interest. It doesn't generate cash flow. Why would I own it? And that's a fair question. But here's the answer. Gold preserves purchasing power. When your dollars are losing value at 7 or 8 or 10% a year, earning 2% interest in a savings account doesn't help you. You're still losing purchasing power. Gold doesn't pay interest, but it doesn't lose value the way fiat currency does. Think of gold as a store of value, not an investment. It's not supposed to make you rich. It's supposed to keep you from getting poor. It's supposed to preserve the wealth you've already accumulated. And in an environment where currencies are being debased, that's exactly what you need. The other argument you'll hear is that gold is a barbarous relic, that it has no place in a modern financial system. But if that's true, why are central banks buying it? Why are billionaires accumulating it? Why is China stockpiling it? The people who call gold a barbarous relic are the same people who benefit from the fiat currency system. They're the ones who can print money and buy assets with it. Of course, they don't want you to own gold. They want you to hold their paper. But you don't have to listen to them. You can look at the evidence and make your own decision. And the evidence is clear. Fiat currencies always fail. Always. It's just a matter of time. And when they fail, hard assets are what survive. So what should you do? Start by assessing your current portfolio. How much of your wealth is in paper assets, stocks, bonds, cash? How much is in hard assets? If you're like most people, you're heavily weighted toward paper. That's a problem. You need to rebalance. Consider allocating 10 to 20% of your portfolio to precious metals. That's enough to provide meaningful protection without being overly concentrated. You can buy physical gold and silver coins or bars. You can buy shares in gold and silver mining companies. You can invest in commodity-focused funds. There are multiple ways to get exposure. The key is to start now. Don't wait for the perfect moment. Don't wait for prices to pull back. Don't wait for confirmation from the mainstream media. By the time everyone agrees that hard assets are the place to be, the opportunity will have passed. This is your wake-up call. The death of fiat is happening right now, in real time. The signs are everywhere. The central banks are panicking. The bond market is breaking. The currency wars are intensifying. And the people who understand what's happening are positioning themselves accordingly. You have a choice. You can ignore the warning signs and hope that everything works out. You can trust that the government and the Federal Reserve will somehow fix the problems they created. You can believe that the dollar will remain strong and stable despite all the evidence to the contrary. Or you can take action. You can protect yourself. You can convert some of your paper wealth into hard assets while you still can. The window of opportunity is closing. Not tomorrow, not next week, but it's closing. And when it closes, the people who didn't prepare are going to be devastated. Don't be one of them. Get hard assets. Protect your wealth. Secure your future. Because what's coming is going to separate the prepared from the unprepared, and you want to be on the right side of that divide.